Welcome back to the deep dive. Today, we are tearing apart one of the oldest, largest, and, let's be honest, one of the most frustrating markets in the global economy.
Credit lending.
Exactly. I mean, you borrow money, you pay it back, hopefully with interest.
Yes.
It's not so simple, right?
Deceptively simple.
But the inner mechanics of a loan, the hidden costs, the bureaucratic friction, it's all wildly complex. And right now, AI is fundamentally disrupting every single one of those mechanics.
Yes, it's a huge shift.
So our mission today is to take the source material and really dissect the two essential parts of any loan, whether it's commercial, consumer, a mortgage.
Anything.
Anything. And those two parts are the price of the money and the process you go through to get it. We want to go beyond the headlines and find those specific, quantifiable insights.
The aha moments.
The aha moments, yeah, that prove this isn't some future-gazing stuff. This is happening right now.
And this dive matters directly to you, the listener, because whether you have a mortgage, a credit card, or student loan, these hidden costs have always been there.
And you've been paying for them.
You have. The failures, the marketing waste, the bureaucracy. It's always been funneled back to the consumer through higher interest rates. So by understanding what drives that price up, we can really grasp the scale of the improvement.
Okay, let's unpack this. We have to start with the economics. Why is the interest rate on a loan what it is? If we strip away the profit margin for just a moment, the cost breaks down into four primary massive buckets.
Right.
The first, and it's often the most insidious, is customer acquisition cost, CAC.
CAC is just brutal in the lending world. I mean, you have the legacy costs, the physical bank branches, the staff, the utilities.
The old way of doing.
The old way. And now you have the modern costs, the digital battlefield of ads on Google, Meta, or running these huge television campaigns. You have to pay for all of that just to bring a customer in the door.
Let me pause on that idea for a second. You mentioned advertising costs. That sounds like a fundamental weakness in traditional lending. Well, because of the product itself. Unlike, say, retail, where I advertise a sweater and 99% of people who like it can buy it with credit, a lot of people who want the product, the loan, they can't be approved.
Precisely. And this is the systemic waste of traditional credit acquisition. You might run a campaign that costs millions of dollars, gets 1 million clicks, only to find out that, say, 70% of those people were never approvable in the first place.
So you just wasted all that ad spend.
All of it. And you're underwriting resources on people who just won't convert. That waste is a cost that has to be subsidized by the loans that actually do close.
Wow. Okay, so then we move to the hard costs of just processing the application. You call this people and data.
Right. This is the expense of originating the credit itself, pulling scores, credit scores, fraud scores.
Having a human analyst look at documents.
Exactly. Reviewing documents, dealing with the small percentage of bad actors or people who submit fraudulent info. These are, tangible labor and data costs for every single application, approved or denied.
And finally, the most visible part, but maybe the least understood component, credit losses. Everyone knows that not every borrower pays back their loan. But the key insight here is who covers that loss?
Well, the ones who do pay it back. If you are a borrower who pays back every dollar on time, you are, by economic definition, subsidizing the losses from those who default.
So that subsidy has to be baked into the interest rate for the entire portfolio.
It has to be.
Yeah.
And the less efficiently the lender can predict that risk, the bigger that subsidy has to be for everyone.
So we have this gigantic four-part cost machine driven by waste and subsidy. Now let's get to the exciting part. How AI is structurally attacking those four cost drivers.
And structurally is the right word. We're not talking about optimization here.
Not a 5% improvement.
No, not 5 or 10%. The data from the sources shows a total restructuring of the cost basis. And we're looking at results to date, not future projections. And they are.
Yeah.
Well, that's already astounding.
Okay, let's start with that waste, the customer acquisition cost. By using better models that improve conversion and cut down wasted ad spend, one key player in the sources has seen 5 times growth since 2019.
Which is huge on its own.
It is, but at the same time, they've achieved a massive 50% reduction in acquisition costs per loan.
Think about that for a second. In almost any scaling business, as you grow, finding the next customer usually gets more expensive.
Yeah, CAC tends to go up.
It goes up, or maybe it flattens. To grow 5-fold and cut your acquisition cost in half means the AI models are fundamentally changing who they target and when.
But how does the AI specifically target non-converters before you spend the ad money? I mean, that sounds a bit like magic.
It's sophisticated data science. The models identify the earliest digital footprint of a borrower, where they click, how they navigate, the first bits of data they provide, and they immediately apply these advanced propensity scores. If the model instantly flags that person as having a super low probability of approval, the system just stops spending money on them. No costly retargeting campaigns that a traditional bank would still run. It stops the waste at the source.
That completely shifts the economic equation. Okay, now let's look at the back end, the people and data costs.
This is where automation has been just radical. Since 2022, leveraging these systems has led to a 66% reduction in people costs for originating a loan.
66%.
And automation removes not just the labor, but also the data costs, because you're not pulling expensive credit reports for applications that we're never going to convert anyway.
That is a staggering amount of efficiency in such a short time. It does raise a critical question, though. If these models are getting so much better at separating good risk from bad risk,
An ability to separate, yeah.
doesn't that just mean they're excluding more people? How does that lead to more approvals for everyone else?
That is the right question to ask. And it brings us back to that subsidy model. The AI's success in cutting down credit losses means the required subsidy just plummets.
So the cost of capital loss goes down.
It goes way down. And the lender now has economic flexibility. They can keep their profitability while either passing savings on as lower rates, or they can expand their approval criteria into what used to be risky segments, but at a now profitable price.
So you get both.
The net result is lower rates for the super prime borrower and more approvals for the mid-prime borrower, because the entire cost structure is just safer.
And if the market is competitive, which lending definitely is, this freed up value doesn't just go back to the lender as pure profit.
No, not all of it. A lot of it flows to the consumer as a fundamentally better product, lower rates for the same risk profile.
Yeah.
The AI creates this persistent competitive advantage that others just can't match.
Okay, so that's the price. Now let's shift to the second crucial feature, the process. For anyone listening right now, why is getting a loan suck so much?
It's defined by friction and bureaucracy, isn't it? It
Yeah.
feels like an interrogation by paperwork.
Exactly. We have all been there. I remember my first mortgage. I felt like I was supplying documents just to prove I was worthy of the headache. We know the pain points. Number one, endless applications. A mortgage application feels like you're writing a short novel about yourself.
And then the documentation hell. Piles of requests, driver's licenses, proof of residency.
3 years of tax documents, 4 pay stubs from different periods. You spend days, literally days, just compiling and uploading this stuff.
Don't forget the awkwardness of employer verifications. You know, who doesn't love their boss getting a cold call about their finances?
And of course, the one constant of lending,
Right.
waiting. Waiting to hear back, waiting for underwriting, waiting for the closing date.
And sometimes, at the very end, that completely inconvenient in-person closing requirement, the whole thing just feels designed to test your commitment.
It really does.
But that's the traditional model. It's built on the assumption that friction is necessary for security. But here is the dramatic counterpoint from the sources, where the process revolution is already here. In the leading companies using these proprietary AI foundation models, approximately 90% of their loans have none of these steps.
Not one. That is a staggering number. 0 documentation, 0 waiting, 0 friction for 9 out of 10 borrowers.
It leads to the vision that the sources describe as always on credit.
So credit is no longer this painful thing you go through. It becomes...
Attribute. It's just something available to you, perfectly priced, with almost 0 friction.
That sounds incredible, but this is where my critical side kicks in. The traditional steps, the documents, the calls, they exist for a reason, right? Fraud prevention, identity verification.
Sure.
If 90% of loans require no documentation, doesn't that just open the door wide open for sophisticated fraud? How do you know who you're lending to?
That is the challenge, and that's why you need this incredibly sophisticated proprietary engine, the foundation model for credit. The model is the verification layer.
It replaces the paperwork.
It replaces the piles of documents with continuous data ingestion and verification. It runs thousands of proprietary signals in milliseconds that verify identity, income, and residence more accurately than a human reviewing a pay stub ever could.
It's security without friction.
Exactly.
Okay, let's dig into this foundation model itself. We're all getting familiar with generative AI models like OpenAI or Meta, which train on, vast amounts of public data. Why is this foundation model for credit so different?
Because it is built on an entirely proprietary data set. Generative models use the internet, The credit model is built on billions of proprietary transactional and behavioral data points that are produced from the lending system itself.
So you can't buy this data.
You can't buy it, you can't scrape it. You have to execute millions of loans, track the outcomes, and then feed that loop back into the model for years and years. It makes the advantage defensible and extremely hard for competitors to catch up.
So the 5 core principles that drive this model, they're like it's source code for success. Let's start with the first one, separation.
Separation is the fundamental concept of underwriting. It's the ability to accurately separate good borrowers from bad borrowers. It's about understanding the risk of the whole population to find that sweet spot.
Next up is automation, which is the driver of that zero process experience we were just talking about.
It is absolutely central to improving conversion. And we saw proof of this years ago, where lending experiments found that for every single document you requested from a potential borrower, you lost about 15% of your pool.
15% per document. That's huge.
It's massive. Automation eliminates those requests, reduces drop-off, and maximizes conversions, which, feeds right back into cutting your CAC.
The third pillar is calibration. This sounds like it's more than just underwriting an individual's risk.
It is. Calibration measures and understands how the macroeconomic climate is impacting borrowers as a whole. So the model doesn't treat the economy as static.
So if the Fed hikes rates?
If the Fed hikes rates unexpectedly, the model instantly recalculates the risk exposure of everyone, adjusting lending standards immediately. It's about precise, real-time handling of macro shifts, not waiting months for government stats.
That dynamic ability sounds incredibly powerful. Okay, the fourth pillar, generalization.
Right. So while you could build a great model for one type of credit, the long-term goal is a unified model that handles all forms of credit: personal loans, student loans, auto loans, maybe even mortgages eventually.
And we're seeing steps toward this now.
Yeah, like unifying small dollar loans and personal loans onto the same model. It makes the system dramatically more efficient and scalable.
And finally, the new frontier, the most exciting part, personalization. This moves beyond just predicting outcomes.
This moves to shaping outcomes, and this is the critical step for both the lender and the consumer. It starts in areas like servicing and collections, where they're using generative AI and agent-based tech.
So instead of a generic, harsh, "you're late" notice.
Exactly. Instead of that, the generative AI acts as a smart agent. It analyzes the borrower's history, the current macro conditions, and it proactively reaches out with, say, highly specific micropayment plan adjustments to help them avoid default.
So it's not just flagging a late payment. It's actively using generative tech to negotiate a new, specific payment plan to prevent a default from ever happening.
Precisely. The system is actively helping people who might have otherwise defaulted move into a better place. And this isn't charity. It's a powerful feedback loop.
How so?
Well, preventing a default saves the lender money, which reduces the subsidy burden on all the other paying borrowers, making the whole system smarter and better. The borrower succeeds, and the lending model improves.
That structural shift, that drive for a 10x AI advantage, it has to lead to, massive market dominance.
It does. All the strategic goals funnel down to one measurable output: giant leaps toward the best rates and the best process for all segments of the market.
And the sources confirm this isn't just theory. In their core personal loan product, the company has achieved the highest win rate among the competition across all 3 major borrower segments.
Super prime, mid-prime, and non-prime. All of them.
All 3.
And this is the completely predictable and logical endgame when superior AI meets strong business execution. It's not about willy-nilly lowering rates or taking on bad loans.
No.
It is the result of superior models being able to accurately identify, price, and manage risk across the entire population better than legacy systems, whose costs are just inherently inflated by waste and bureaucracy.
That is the massive takeaway we wanted for you today. AI isn't just, optimizing existing loans. It's redefining credit as an instantaneous attribute rather than a bureaucratic process. The price and complexity of a loan are now directly tied to the sophistication of the underlying proprietary data model.
And that personalization goal, moving from predicting who will fail to actively helping people succeed, that is the future of responsible finance. It makes the entire ecosystem more stable, more efficient, and ultimately fairer for everyone who actually pays back their loan.
So here's the final thought to deep dive on. If superior AI execution drives rates down and process friction to near zero, what happens to traditional banks? The ones whose models rely heavily on physical branches, outdated data and those large subsidized losses?
That's the billion-dollar question.
Are they forced to pivot and try to build competing foundation models? Or will the defensible advantage of proprietary data just widen the gap until traditional high-friction lending becomes a relic of the past? We'll let you deep dive on that thought.
Thanks for joining us.
Thank you for joining us for the deep dive. We'll see you next time.